Happy Tuesday. DSW up 20%. Tiffany strong as well. You're right on that, Carl. Retail strong here. 2-1 advancing to declining stocks. Take a look at the sectors. And again today, when you get the dollar down, we've got this round trip on the dollar up and then down really in the last 2 weeks. Helps a lot for anything related to materials, anything related to metals and mining stocks. There's a group again. Semis are again coming back here very strong. Retail, as you heard earlier, doing a lot better. The market advance is continuing and the rally is broadening out. And that's been my theme late yesterday and into today. Look at indices that are simple and just track broad sectors of the market, like the equal weight S&P 500. Every stock, same weighting in the S&P, hit an historic high. That tells you the average stock is advancing. Other ones that people watch, the Value Line Composite Index. This is the old one. It goes back into the early 60s. Again, designed to measure the median stock advance. Equal weighted, about 1,600 stocks are in this index. Historic high today. That tells you it's not just FANG names. The overall market is slowly advancing right now. So the rally's broadening out. What do we have here? We have major indices hitting historic highs. Most of them are market cap weighting. We have the advanced decline line, which is the key to the whole market, at record high. We have new highs breaking out that are fairly modest. The average stock, as I said earlier, also at an historic high. The new high breakouts is a little problematic. We're not seeing hundreds of stocks breaking out, but take a look at the S&P 500. Right now, essentially at an historic high. I'd say 20-25% of the S&P 500, if you put up the S&P there, I'd say 20-25% are within 2% of historic highs. So you go up another 1 or 2%, you'll see hundreds of stocks hitting historic highs. So the important thing about the market, the rally keeps advancing, and it's not dead yet. There's plenty of reasons why we keep advancing. All of the things that people thought were going to kill the market have not. Fed tightening, not killed the market. Higher commodity costs, remember that story? Not killed the market. And the trade tensions, although it does move the markets on a daily basis, hasn't killed the market either. And the reason is because what we have got with the U.S. economy. Strong U.S. economy, record earnings, buybacks and M&A activity, sort of internals of the market have been very strong. You want to quibble about something, a lot of strategists are talking about the global economy. Those numbers are a little less favorable, and you can see that just looking at our numbers versus Europe. European earnings numbers versus the United States numbers. It's rather startling when you see we're talking about 23-24% growth in earnings in the United States. The European growth is considerably smaller than that. Take a look at that, only 9%. Now you take out tax cuts, our U.S. growth would be 16% or so. So we're still outperforming. Just take out the tax cut effect. We're still outperforming. Same situation with revenues, 10% revenue growth. That's why people are so impressed with our rally. It's not just tax cuts. Revenues are much stronger in the United States. And look at that. It's 1/4 what it is in Europe, 2.8% revenue growth. So there's a little bit of a concern. But on the issue of like a global recession, with global central banks so accommodative, it's hard to believe that we'd slip into some kind of global recession here. But look, the markets are telling you the U.S. is the place to be. 8% this year. Germany is down. Japan is down. Shanghai is down. The only big market that's notably outperforming is India this year. That's up close to 12 or 13%. But there's some very exceptional reasons why India is doing well. Overall consensus, U.S. still remains the place to be. As I said, 2-1, advancing to declining stocks, up 68 points. Carl, back to you.